Hi, I'm Guillermo Narvaez, Technical Tax Director of the Global Tax Group of Crescent Global, and this is the 2021 November and December edition of the InTax News. Welcome to the program. In this November and December edition, we have news concerning international tax matters, like the Spanish case of General Anti-Abuse Rule and denying of MAP, more beneficial ownership rulings from Denmark, the so expected new treaty between France and Belgium, new rules on cross-border reorganizations in Norway, and how Belgium clarifies the deduction of business losses from abroad. The news to discuss in this edition is divided into two videos. In the first one, Spain, domestic GAR and MAP. Can't a domestic general anti-abuse rule live in harmony with a mutual agreement procedure of a DTA? Belgium, deduction of losses from abroad. Finally, Belgium clarifies how to deduct such foreign losses. And in the second video, the news is Denmark, the TDC case. Another milestone decision from Denmark on beneficial ownership. France and Belgium, new double tax agreement. After many years of trying to amend the rules, France and Belgium finally achieved a new whole tax treaty with multiple changes from the still in force treaty. Norway, cross-border reorganizations. A proposal from the Norwegian government to update the rules to apply to international reorganizations. Welcome to the 2021 November and December edition on the InTax News program. I trust you enjoyed. The Supreme Court of Spain, or Supreme Tribunals, ruled on the case of SGL Carbon Holding to define whether a MAP or mutual agreement procedure would apply given the potential existence of tax abuse. The Supreme Court finally confirmed a MAP would be not legally acceptable given the background of tax abuse surrounding the case. The Spanish tax agency assessed a tax credit to SGL Carbon Holding, denying the benefits on the deduction of interests paid to the headquarters of SGL located in Germany, as well as the impairment of the shares of another subsidiary acquired by SGL. To determine the existence of tax abuse, the Spanish agency grounds assessment in the domestic tax framework, specifically in Article 15 of the General Tax Code. Subsequently, SGL requested to start a mutual agreement procedure in accordance with both the double tax agreement between Spain and Germany and the EU Arbitration Convention, but the request was denied by the Spanish tax agency on the grounds that there was an abuse of law by the taxpayer, and a MAP cannot initiate when the Domestic General Anti-Abuse Rule, or GAR, has been applied. The position of the tax agency is supported in a domestic piece of legislation or royal decree that regulates the appliance of this kind of mutual procedure. The royal decree determines that the possibility to deny access to a MAP when there is no divergence or discrepancy with the respective DTA, or there is clear evidence of abuse of the treaty when the taxpayer tries to avoid taxation in either of the signing states. The Supreme Court affirmed that applying the domestic GAR or the regulation of MAP of the royal decree doesn't arise a conflict with the DTA. The court also affirmed that a DTA cannot be applied when there is an abuse of law or fraudulent activity by the taxpayer. Subsequently, the court didn't enter into the study of the provisions of both the DTA and the EU Arbitration Convention with respect to MAP and the possibility of applying it. In other words, the court concluded that the domestic legal framework of Spain was sufficient to solve the matter and ruled the case, although the assessment of the tax agency was likely to be related to the DTA between Spain and Germany. The court confirmed the arguments of the tax agency that the DTA allows the corresponding states to apply domestic provisions on the provision of tax avoidance or evasion grounded in Article 28 of the DTA. Additionally, the court dismissed the applicability of the EU Arbitration Convention on the grounds of such convention refers to cases of transfer pricing and adjustments in the value of operations, which was not the issue at stake. It looks like the Spanish Supreme Court went against international standards when denying access to MAP, and in consequence, the corresponding DTA, given to the local GAR preference over the international agreement between the corresponding states. However, the key element to define to get to such takeaway is whether the provisions of the treaty, irrespective of the MAP provision contained therein, applying in the current case, although the controversy to define is based on a domestic provision like the Spanish GAR. The Belgian Tax Authority has issued an official communication to clarify the rule of the possibility of deduction of business losses generated abroad. The general rule is business losses from abroad are not a deductible item in Belgium. However, some exceptions apply to this principle. The main facts to consider foreign tax losses deductible are that they are deemed as definitive and generated in a state within the European Economic Area and have a DTA with Belgium. Business losses may be definitive when either the taxpayer that generated it terminates activities or has no assets in the corresponding state where it is located. Moreover, the business losses will only be considered as definitive if there is no possibility to deduct the losses in the state where they were generated, or deducted or offset against other activities carried on in the same state or by a permanent establishment of the company. Likewise, if the company in the other state resumes activities in a period of 3 years after applying the deduction of the losses, the amount deducted must be accrued by the company. Finally, tax treaties and the system to avoid double taxation therein agreed may apply when definitive business losses have been generated in a state part of the Economic European Area and have a DTA with Belgium.